Hello and welcome to Multnomah Group's Capital Market Review for the fourth quarter of 2021. My name is David Williams. I'm a consultant and director of investment services here at the firm. I'm going to quickly go over some highlights for the U.S. economy and then get into a discussion of the capital markets for the fourth quarter and full year. We'll start with a discussion of U.S. gross domestic product. The GDP grew at an annualized rate of 6.4% for the fourth quarter. Consensus was that growth would be around 5.3%, and it was certainly better than growth reported for the third quarter of 2021. Personal consumption figures were up, while durable goods purchases declined relative to the prior quarter. Fourth quarter really came in between waves, variant waves of the COVID pandemic. Delta just wrapping up as the quarter began and really getting most of the way through the quarter before the Omicron variant came and really impacted high frequency economic activities like travel, dining, and spending along those lines. Their expectation is that January and February we'll see a dip in some of those high frequency activities and put some pressure on U.S. GDP growth for the first quarter. For the full year, U.S. GDP grew at a 5.7% clip. That's the fastest since 1984 and a significant rebound off of the 3% decline we experienced during 2020. From a fiscal standpoint, we saw the $1.0 trillion infrastructure bill was signed into law in November, but the Build Back Better or social spending program stalled during the quarter as well. Some thoughts is there will be effort to bring portions of that through Congress here in 2022. But really, the expectation ultimately is that the effect or additional fiscal packages will be less in 2022 as compared to 2020 and 2021 during the early stages of the pandemic. Quickly transitioning to discussion of the Fed, the Federal Reserve Bank and their dual mandate certainly has a lot of attention right now. The Fed is focused on two things, really full employment, and we're seeing that is improving, and maintaining stable prices, which obviously there's a lot of concern with respect to inflation figures that have been reported for this last year. Starting with employment, we did see slower job growth in December as just under 200,000 non-farm payroll positions were added during the month. The unemployment rate has come down to 3.9%. So we've made a lot of progress with respect to the 22 million jobs that were lost during the early days of the pandemic. About 19 million of those 22 million jobs have been recovered. We also have seen quite a bit of wage growth this last year, as the annualized wage growth is reported at 4.7, which is by far some of the largest figures we've seen in the last 20, 30 years. When we look at the other side of the dual mandate and looking at stable prices, maintaining stable prices, definitely seeing some significant headwinds there with the core CPI, which removes food and energy, and it's a figure we look at probably most closely, being reported at a 5.5% year-over-year clip. So it's removing some of those higher volatility priced items like food and energy, but still at 5.5%. While the headline number, which does include food and energy, came in at 7%, which is really the highest we've seen in 40 years. So while we're seeing wage growth, the amount of inflation is more than that average wage growth. So there is declining purchasing power going on. There's been a lot of talk about what is the Fed going to do to combat this rising inflation, and how will they balance the mandate of keeping the economy chugging along and people employed without while still attempting to slow some of the rampant inflation. So what we've seen is the Fed has become more hawkish, and so most recent meeting, no announced changes to the short-term overnight borrowing rate. So those are going to stay right at the 0 to 25 basis points figure, but they are signaling rate hikes will begin here in 2022. On the long end of from a long end of the curve standpoint, they are intending to end their bond purchasing program, which started during the early days of the pandemic here in March. So you're definitely anticipating seeing some movement in interest rates this year. So how did this impact capital markets during the quarter? On this slide, we show returns for on the upper piece here, returns by sector for the S&P 500 for the quarter, 1 year, 3 year, and 5 year. And then at the bottom of the page, we have information on different style-based indices for those same periods. So the S&P 500 was up right around 11% for the quarter, up 28.7% for the full year. So again, another very, very strong year. All sectors of the S&P 500 were positive for the quarter, except the communication services sector, which was just slightly negative. And all sectors were positive for the full year. For the full year, energy and real estate sectors really led the way, rising due to what we're seeing, rising energy prices, but also inflationary concerns, and REITs tend to have a bit of correlation to rising inflation. We do see that the forward price to earnings ratio continues to be high relative to historic averages. So stocks are expensive relative to their historic averages at 21.2 times versus a 25-year average at 16.8 times forward earnings. At the bottom of the page, we look at returns by style. And what you'll see for the quarter is that growth outperformed value in the large cap space, and then it reverses in the small cap space as small cap value outperformed small cap growth. Longer term, the growth versus value outperformance continues. Looking at whether you look at 3 or 5 year numbers, growth outperforming value, and large outperforming small cap stocks. So those longer term trends continue this past year. Flipping to the next slide, we review fixed income markets. The Barclays Aggregate Bond Index, the Bloomberg Aggregate Bond Index was flat for the quarter. For the full year was down 1.5%. We have seen some upward movement in the yield curve. For the quarter, there was very little movement in general. In the intermediate term section of the yield curve, a little bit more upward movement at the short end of the curve. Tips and high yield were generally the better performing sectors of the broad bond market. Investment grade credits did a little bit better than traditional nominal or government-backed nominal bonds for the quarter. So again, due to higher economic growth, improving or still solid corporate balance sheets, do see those investment grade and high yield bonds outperforming similar duration government securities. As we move forward and look at the international equity markets, the All Country World, the MSCI All Country World ex-US Index was up 1.8% for the quarter, up 7.8% for the full year. So right off the bat, you can easily see that US equities strongly outperform broad foreign markets for the quarter and for the full year by significant margins in both periods. Developed markets outperformed emerging markets, and the European zone outperformed the Pacific developed markets. We do see, from a kind of similar reporting to what we said on U.S. equities, the all country world ex-U.S. price to earnings ratio is more expensive than historic terms, but the difference is much less. The forward price to earnings ratio is 14.3 times for current forward PE, while the 25-year average is closer to 13.3 times. So stocks are expensive outside of the U.S., but not nearly to the degree as what we see in the U.S. on a forward-looking basis. Looking at this, we can call it the periodic table of investments, or a quilt graphic, where we look at the major asset classes offered to defined contribution plan participants, looking at them on an annual return basis and kind of ranking them from best performing to worst performing, going down the page. What you see this last year is that those assets that were, again, it's a risk-oriented environment, so assets with equity risk tended to do better than those with fixed or interest rate risk for the full year. Really kind of a reversal in some respects, a reversal of what we saw in 2020, as assets with more perceived inflation sensitivity really rose to the top, with real estate finishing the year up 41%, while the prior year being down 8.7%. And then commodities coming in there at in the third spot, just behind U.S. large cap equities. Real estate, and from a commodity standpoint, one of the key contributors there, oil, going from $49 a barrel to $75 over the full year. Appreciate you listening into this. If you have any questions, please feel free to connect with your consultant or myself. Appreciate your time, and have a good rest of your day.